Special shout out to our sponsor, Qualia. Qualia is the category-creating digital closing platform used by thousands of lenders across the country to seamlessly work with their title and escrow partners. By working better together, Qualia is powering lenders to deliver a differentiated closing experience for their clients. Through real-time communications, closing status updates, and workflow management, Qualia brings lenders together with home buyers and sellers, title and escrow agents, and real estate agents for a secure and seamless closing experience. Qualia is proud to have been awarded the Housing Wire Tech 100 Award for real estate, as well as CB Insights FinTech 250 Award. Discover how you can work more efficiently with your title and escrow partners at qualia.com/innovators. That's QUALIA.com/innovators.
Well, hey, everybody. If this is your first time joining us, welcome to the Mortgage Innovators Podcast, where we deliver fresh and hopefully entertaining insights on all things mortgage and the innovation that's propelling our industry forward. My name is Sue Woodard, and every Tuesday, you can find our rotating group of co-hosts who all share their own unique connection to this industry. Today, I am thrilled to have my co-host, Dan Cantanella, Chief Digital Officer at Finance of America, here with us today. Hey, Dan.
Hey, Sue.
Or Big Cat, that's what I always call you. I know you do that. We're also so excited to have a really good friends of both Dan and mine here today with us, Julian Hebron, CEO and founder of Thebasispointcom. How's it going, Julian?
Hey, good, Sue. Hey, Dan. Glad
How
to
are
be
you?
here. I'm good.
Awesome to have you. Super excited to have you today, buddy.
Totally. And this is my first time, so let's see if I can get some other first timers hooked in for you guys.
Absolutely. No, this is gonna be a good conversation because we're actually, Julian, you're such a wealth of knowledge. And so I think both Dan and I were like, man, how do we even pare it down to what things we're gonna talk about? But Dan had two really solid things that he said, this is what we're gonna talk about, really different from each other. One is your insights on blockchain. Dan had a really unique way that you described it. Do you remember what you said in your email, Dan?
Well, yeah, I mean, blockchain for, at least in our industry, for quite some time has been a solution that's been trying to find a problem. And I think, I caught a segment of Julian's either, I think last week,
yeah,
where you were chatting with Sagent and Figure on their views and some of the unique things that they're doing. And you had some fantastic insights that we thought was really, relevant to what, we've been discussing here for the last several months.
Absolutely. So we're going to start with that topic. And I think, Dan, you also made the comment a couple minutes ago. It's like the first time that it really actually resonated, where you're like, wow, okay, I kind of get where this could go. So we're going to talk about that. And then we're also going to talk about the difference between new loan officers and seasoned loan officers dealing with the shift to purchase and the purchase war that's coming up, and what can these two groups of people learn from each other. So with no further ado, let's dive right into blockchain. And Dan, why don't you tee it up with maybe some of what really spurred your attention from Julian's conversation, and let's take it from there.
Yeah, so, I think kind of what resonated with me is, especially as it comes to, customer loyalty and servicing, and really trying to figure out how we make the customer's next transaction, easier, faster, cheaper. And some of the things that you were talking about with, in the servicing world and with Figure kind of just really resonated with me there. Give us a breakdown of, where you're seeing blockchain maybe first enter, our industry, and some of the use cases that actually you're seeing that will actually be valuable.
Yeah, and if I may, I might ramble in moments, but try to be very clear. But I'm not going to go off. But the biggest reason that there is a prevailing belief, and a very justified belief, that blockchain is a solution looking for a problem in our spaces, because we all know how hard this stuff is. We also know that most of the evolution of crypto in the broader financial realm is predominantly speculation on tokens and so forth. So I feel like it's worth just doing a extremely quick primer on blockchain versus crypto. And then it's so much easier to talk about the mortgage space. But then what I could do is just quickly break it down across three areas in terms of how the if you will, that this truly innovative part of the world thinks. The blockchain world sort of views this sector as broken down by lending, payments, and exchange. Lending is for originations, payments is for servicing, exchange is for securitization, okay? So we'll kind of get into that, but if I may, let me just see if I could do it in like 2 to 3 minutes. Is that cool?
Go for
Yeah,
it.
Okay.
you'll impress me if you can do it in 2 to 3 minutes.
All right, so it's like this. First, most folks like that say this, I said even when I promoted last week's session, I'm like, it's not okay anymore to say it's a solution looking for a problem, because it's only a matter of when. It's only a matter of when. It's also, when we think about disruption, so much of the conversation has been around, well, hey, if we could just kind of wring out some either sales or marketing or operational / fulfillment type of cost, then we'll kind of start to get that cost per loan down, right? These conversations have been going on, as you guys both know. We talk about this a lot, the three of us. This has been going on for like generations of loan officers, execs, like of the industry. It's been a few cycles that these conversations have been the same. So I'm starting to come around on this thesis of structural disruption, not just, hey, let's do some software that like kind of makes things little nicer and neater, maybe cuts costs a little bit, but doesn't have any material impact when you look at the MBA's performance report every quarter and you look at the basis points being spent. The only fluctuations are really based on market cyclicality, right? Market cycles, and then just the cyclicality that comes with the cycles. It's not been about the innovation yet. So structural disruption is what I believe that blockchain can finally bring. So when we come back to our 3 areas, they have implications for what that means from a cost structure standpoint and from a consumer experience standpoint, okay? And therefore a loan officer experience standpoint. But first and foremost, what blockchains even matter? Most of the, if you will, decentralized finance blockchain talk is around the Ethereum blockchain. But when you get right down to it, Ethereum and all its DeFi applications that are being built on it are really around serving the crypto marketplace, what I like to say, like the on-chain marketplace. When people say it's a solution looking for a problem in our space, it's just because there's again, a justified perception that the gap is too damn big, right? And so bridging this on-chain to off-chain world and therefore being compliant with the GSEs, the regulators, et cetera, is just way harder than it looks. There's nothing going on in mortgage at all in all of Ethereum. For all of the headlines that defy decentralized finance done on Ethereum gets every single day, every single week, there's not one bit of mortgage and very, very little at most consumer finance as a whole activity happening on the Ethereum blockchain and its associated cryptocurrencies. So there's Provenance, and Provenance was founded alongside Figure. It is a public blockchain though. It is not meant to be some private blockchain. Let's just face it, is a centralized immutable database that is either owned, and if it's owned, it's just not really blockchain. If it sits inside JP or or the agencies say, it's not a public blockchain. So Provenance was built by the team, some of the team that founded SoFi originally. They started shopping it around. They're like, yeah, every institution was like, yeah, we like it for lending on the origination side. We like it for payments on the servicing side and exchange for the securitization side, but we're not going to take your word for it. So good luck with that. So what happened is that team founded Figure, and Figure is basically like SoFi 2.0. And as we know, they bought Homebridge to really officially enter mortgage in a real way recently. And so they started proving this case with personal loans and Helocs to the tune of not hundreds of billions, but several billion, like low billions in terms of proving those cases with Heloc and consumer loans using the Provenance blockchain from origination through securitization, and started to get some institutional buy-in. And now we're in a phase where the next phase is they would start proving these cases using first lien mortgages with if you will, Figure's new scale mortgage operation, AKA Homebridge, right? So as we move into 22, we will start to see those proof cases come. But here's what's happened so far, using Heloc as an example. Like they can, and I'll pause after I do this so we can get into, the consumer, the loan officer, and the institutional experience. But using Heloc as a case study, approximately 117 basis points where I was able to kind of wring out of the system because you don't have things like inflated warehouse expense. You close way faster. You can underwrite and approve that loan in 5 minutes, and it doesn't take 45 days to do a Heloc. Heloc is an interesting case study because it's, as we know, like there's not one loan officer listening today or manager who watches their production that likes Helocs in any way. They're total pain in the ass, right? So that's why they were like, hey, let's start with this because it actually is high yielding for the investor set. They're hard to do. So if we can change the loan officer and the consumer experience and use it as a case to wring some basis points out of the system using the blockchain, we'll do that. Why do you wring it out? I'll use one example and then we'll go to the consumer experience. But where does a lot of that come from? A huge chunk of that, like 100+ basis point savings, can come from things like warehouse, right? So if you have to fund those loans and then leave them on until you can do QC again, until you can sell them to the end investor, what if instead you're like, here's the end investor, I've originated it here, they have a lens into everything that happened from day one, and they are like, well, we'll just fund it and then do the takeout as well, right? So you don't have to go through an extra layer. That's just one simplified example, but it's just one example of how structurally you can kind of carve out basis points, real basis points out of the system, instead of saying, hey, LO, we're gonna try to, whittle you from 150 bips down to like 75 bips by, 2023. That's just I'm just done with that conversation. Yeah.
So it's almost like simplifying a correspondent transaction where you're delivering, basically they're going to have the same data points and analysis that was done up front all the way through the process, and they're just going to basically deliver that same exact data set. So why re-review it and waste time there when everybody's looking at the same, like you said, the same lens, across the board?
Yes, and let me just be real about that for everybody listening that's like, oh God, you just said so much stuff that I'm just trying to digest it all. Our whole world, think about it's easiest to think about the gap, just how big the gap is when you think about non-bank lending and blockchain. Why is the gap so big? Because gain on sale and the culture, industry-wide culture that it fosters, is we have to make sure at several steps along the way that this loan is sellable, right? Or else gain on sale, which is why our industry exists, doesn't exist, okay? But if you are able to originate on the blockchain at the point of origination, say, one of the things that, again, this is a language gap and a conceptual gap, but it's fun when it starts sinking in. Let's replace trust with truth. Everything I just said about our industry structure is based on trust. And it's like, we know you trust us, but we also know that you're going to verify this loan for the third time in the chain, if you will, as it moves from origination to warehouse to sale to servicing to securitization. It gets reviewed over and over and over,
like 17 times, right?
And these parties do trust each other, but they do until they don't. So
trust but verify.
But nevertheless, a trust-based system, and the whole concept of blockchain is replacing trust with truth. An immutable, decentralized public record of all links in the chain, so to speak, replaces that trust with truth.
An interesting point that I just want to touch on with that is there was some research that Stratmore has done. The biggest thing that will cause a massive drop in an NPS score is when a customer is asked for, in their minds, what's the same piece of information multiple times.
Mhm.
And it's very frustrating
That's
to the lender
exactly
because
right.
they're saying it's not the same thing. It's like, the statement got old because of all of the things that you're talking about. And it's literally the thing that causes the most dissatisfaction, not the loan officer's fault, not the lender's fault. It's because of things like this. And so if I'm understanding right, this would help to resolve that problem.
And it is happening. It's happening across all of these other bigger blockchain applications. Again, on the Ethereum blockchain, it's all happening with respect to mostly cryptocurrency token trading and so forth. And there are some certain things that are starting to happen, but it's mostly, again, things that are on chain is the fancy language for it. But in our world, where it's still starting with this you're taking a giant industry and kind of, yes, we've digitized, but it's still not a native digital asset, right? A mortgage and its package, if you will, is still not truly, totally a native digital asset just yet. But in these use cases that have been happening, just using this one example of Provenance with Heloc and consumer loans, so that's exactly what's happening. And most importantly, that part does have a consumer user interface layer where it's like when you're doing if you will, like the POS functionality and direct connecting the assets and all that stuff, it is verifiable from step one. Because I still think direct connect for POS functionality is still super cool,
Mhm.
but it's only as cool as you don't have to verify it 20 more times down the
Right.
line. And that's where blockchain will start to come in. Now, timeline, I think I can make that real simple. Again, I think that the one that I believe is the most probable at this moment, and this space is evolving so fast, but how do you get all the scale within our space, within the investor space, within the servicing space, within the GSE and the regulator spaces as a public blockchain? Today, I think I'm not confident in anyone other than Provenance this time. That could change, but it just seems like they're the ones that are proving these cases for real in terms that we all care about and that we can understand. And when I talked to Mike publicly last week at Figure and Provenance, he said that the target is like 10 to 20 billion of first lien with the new home bridge relationship that originates on chain. And I believe that if that does happen in 22, there could start to be some real momentum around this. So that's where, for folks that are paying attention, I'm more than happy to field questions that anyone wants to send separately, because it's a little bit of a rabbit hole, but I'm hoping that this kind of does at least help uncloud it a little bit. And you guys know I like catering to skeptics. I always have. I like all the innovation that I believe our space is capable of, so I won't call myself a cynic, but I am one of those skeptics. And I do very much like talking to people who are like, that's BS, man. And on this one, you guys can tell, it's going to take time, but I do believe it's a when, not an if anymore.
Yeah. I think it'll definitely take some time for the agencies to buy in and get all those approvals. But I'm assuming, from your understanding, is Providence kind of it seems like it's the premier first go to market. Do you see others?
At this time, there's nobody else doing anything else meaningful across, again, lending, which is originations, payments, which is the servicing bit, and exchange, which is the securitization bit. You have to get all three to get this right at scale. And, in an industry where we're going to, do 10 million plus loans every year to the tune of, 2 to 4 billion, it's just not, and then outstanding servicing hovering around 12 billion all the time, 12 trillion, excuse me. And I think I said billion about originations, but yeah, one more time. For an industry that's doing approximately 10 million loans, 2 to 4 trillion a year in new, and servicing 12 trillion-ish at any given time, you have to have all three. So like little mini, to answer your question, there's always going to be little mini apps that get developed on blockchains that will kind of help a part of the process. But again, going back to my new thesis, structural disruption has to be all three. It has to be all three. And I haven't seen anything yet that's close yet on all three. So I like to avoid cognitive bias. So I'm not so sold on this that I'm like, this is it, but I will say that it's the only one that checks those three boxes at this time.
So
Awesome.
Julian, first of all, will you promise to come back on a future episode of the podcast? Excellent.
Absolutely.
We've got the recording
Yeah,
now.
sorry, I was nodding, but I will say that for the audio only folks, 100%.
Thank you. Number two, because we have one more quick hit topic we're gonna, talk on before the way out. But number two, I know you just intrigued a lot of folks, including me. Thebasispoint.com is where people could go to sign up for your newsletter and probably continue to follow, listen, learn. Is that best course of action for folks?
Yep, that's correct. Thebasispoint.com is updated every single day. And then I'm more active on Twitter than I am on like LinkedIn or Instagram or Facebook. I know a lot of mortgage folks are too busy doing loans to like hang around on Twitter, but at the Basis Point on Twitter is also, a good ongoing source daily.
That's good for everybody listening, because I'm sure we're just starting to crack the surface of what's going to happen, and you'll be a great person for people, including me, to follow.
Before Sue, we do the next topic, to close this one out, because if your head is spinning like, oh my God, that's a lot. It is a lot. Let me start by one that helped me break this through in my own head as I was digesting it all. Everyone knows of Bitcoin, and almost everyone at this point starts to know like what Ethereum is. Those are the two highest priced and most widely followed blockchains. If you know nothing else from today, just in terms of like, I still don't get it. It's like this. Bitcoin as a blockchain, it's the Bitcoin blockchain, big B, and then small b, Bitcoin is the crypto that's associated with it. Bitcoin is meant as like a so-called like world currency, right? That's its primary use case and its primary purpose for existing, okay? Ethereum is the blockchain, Ether is the associated cryptocurrency, and that is meant, if you will, as like a world computer. Some of you guys like use VMware to kind of pipe into your machines and stuff like that. VMware like runs virtual machines. It's like a giant computer, and then you run your little instance of you work for your lender within that. That's like what Ethereum is. It's where that's where everyone's building these apps within Ethereum to create, if you will, the future of finance, right? So that if you retrace that to what I said earlier and say, is anybody building anything to solve our origination, servicing, securitization chain and mortgage on Ethereum? The answer is absolutely not today, not at that across the life cycle level. And as we all talk about with the consumer, if you view it, Dan and Sue, through the consumer lens, from origination through the lifetime experience, if you're not addressing all three, you are a solution looking for a problem.
Yeah, completely agree.
Well, Julian, I feel a little bit like we're in the Matrix. So
it's a big rabbit hole, and there is a new Matrix 4 coming out, so we're right on schedule.
It's amazing. What we are going to do is, like I said, now that you promised that you're going to come back to a future episode, we are going to hit this last topic, but we're going to hit it fast. So I'm going to look for a couple of like just quick things about new loan officers versus seasoned loan officers. Where can they learn from each other as we're heading into this purchase market?
Dan, do you want to start? I feel like I've been doing all the talking. I feel bad.
Well, I'd love your take on this, honestly. I think, new loan officers getting into the purchase market and trying to figure out how to get in the door at, referral partners, offices, real estate agents primarily, especially in still the, pandemic world, has other challenges as well. I'd be interested to see, hear from you on what you're hearing working or not. We definitely have some of our own challenges with new loan officers as they try to, pick up new business and engage with customers through that lens. I'd honestly love to hear from your take.
So to honor Sue's previous comment, I'm going to stick with the matrix analogy, right? So we know from the first two sequels that the matrix was built again over and over. And to me, this matrix also, we are always innovating, let's be clear, but this matrix gets built over and over. And Dan, of all people, you are super close to the production, and you know that a lot of things stay the same. We also know that it's been a long time since we've had just a full-blown purchase market. And this one that's coming is very stark. We are going to go from, let's see, NBA just updated today. So we're going to go from 11.4 million units total this year to about half of that next year in total units. And most of that drop is from refis. About 5 million refis go away, and purchases stay the same at about, let's call it 4.8 million units. Let's call it like 4.8 million units to go around. That's the great news. But the old versus new is like this. This is old school tactics, like matrix being built again type stuff, as far as I'm concerned, because the great loan officers are too busy to go work the ground. But one thing about the real estate side of things is that the ground game hasn't changed. The ground game is I'm still hammering signs into the ground and putting them up around the unit and like trying to get people to drive to the unit. And I'm sweating and ruining my fancy clothes and like holding these houses open. And if somebody shows up and shows that they care, it still matters. And the busy loan officers aren't going to do that because they don't necessarily need to. They have the cred, they've got the relationships. And so the old school tactics for the new loan officers is one thing, is like showing up totally matters. It totally matters. Like you go there, you chat these people up. And I have been debating this a little bit with folks lately. And it's like, yeah, but the people, whatever realtors get listings are super established and they don't want to talk to junior people. Here's my answer to that. Yes, and because of that, they are often having their new team members that they are mentoring host those open houses.
Yep.
So if you're new and you go, you don't have to meet the hitter. You have to meet the hitter's new assistants that they're grooming, and those people are trying to become realtors themselves. So this is just blocking and tackling selling stuff. I mean, I wouldn't call this innovation, but I do think it categorizes as innovation for people that really cut their teeth these last few years on refis, and they don't know what a purchase market's like. And frankly, all they're hearing is you're in trouble because you didn't take time to meet realtors. And I disagree for the reasons that I just stated. That's one. And then two is they can teach the old schoolers about all the digital stuff that they know natively really well, right? So that's the part that the seasoned agents that don't necessarily have teams, let's face it, they're the harsh word would be fickle, but they're fickle. Like they will switch lenders if somebody else woos them. And if you can show them, like through Dan as an example, a lot of the tools that you offer through Finance of America, that some of the slick digital stuff that you can do for them and help them run their listings and market their book, that stuff lands with seasoned realtors that are like, I just know how to get the listings and I don't know any of this digital stuff.
Right.
So
And I think we see more adoption from the younger, newer LOs into the digital tools for a lot of different reasons, not just because they're younger, but more probably just they're open-minded and trying to get every competitive edge as possible to meet a new realtor. But I think what we've seen work most is when we have these junior LOs that are paired with those seasoned loan officers. And similarly, like you said on the real estate agent side, but those junior LOs pair with those seasoned loan officers that can help promote those digital tools, do the grunt work of getting out there in front of those, real estate agents that those senior loan officers have had relationships for a while, as they try to kind of build their team and expand.
There's good muscle memory in that sense, and there's some that's also not as good, right? And so that's why I think it's a beautiful pairing. So Julian, any final comments before we wrap up?
The one thing I would offer is that it for those who are listening and are new and haven't really been through the purchase market yet, like fully, it's a different set of muscles. But once you get into a rhythm on that, my experience proves that it's anywhere between one, but especially by the time you've done 3 deals for one realtor, if you crush all 3, they are yours. So just know that it takes a little bit, but once you do that, you get them. And for what it's worth from a competitive standpoint, if you're wrestling that away from somebody else, that if you will, incumbent loan officer is going to step up on like deal 2. So you are going to need some help with your management on pricing and so forth, but you've got to know how to make those cases internally. Like you can't just whine, frankly, about your pricing. You have to say, look, here's who this person is. You have to have done your homework. Who is that realtor attached to? And you
That's
have to
right.
be able to make your case to get your pricing exceptions so that you can win those first 3. And if you do, it's a go. You're building a purchase.
Yeah, I
book.
mean, the reality is that most even top producers still have their 10 to 15 realtors that give them 90% of their business. So
That's right.
focus on the right guys and focus big, and hopefully you win big in the end.
Yeah,
I
and
gotta
just
tell you, go ahead, Julian.
I was just going to say, you have to know your internal politics. And I can promise you this, that selling your internal machinery on pricing exceptions on purchases, if you've done your homework on why that you're making that case, is so much easier than selling them on price exceptions for refis. So that's the fun part.
Great
True.
point. I am thoroughly red-pilled. I don't know about you, Dan, but I didn't even bring this up, Julian. Like,
Oh,
because come on, I mean, you bear
kind of
more
looks
than
like
a passing
Julian without
resemblance
glasses.
Yes.
to Neo. So
I'll bring my glasses next time.
you know what? This was so good. This was so good. I mean, we went a tiny bit over time, but man,
Yeah,
everything
sorry about that.
was, no, don't be. This
It's all
was
good.
solid gold. And like I said, we can't wait to have you back. So it has been such a huge pleasure to collaborate with both of you, Dan, as always, and Julian. This was a big treat for the Mortgage Innovators podcast. We want to thank today's audience for listening to the episode. And if you like what you heard, make sure to subscribe to the Mortgage Innovators YouTube channel or wherever you podcast. So with that, until next time, thanks everybody.